Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We have just released our monthly India Market Outlook titled Can the Upturn Sustain? In today's podcast, we summarize our macro and key asset class views. Before we get to that, a quick roundup of the past month. Indian risk assets ended higher for the fifth straight month, driven by resilient domestic macro fundamentals, strong start to the first quarter fiscal year 2023 earnings season, and robust foreign investor inflows into equities. Over the past month, the Nifty index rose close to 1%, performing in line with the MSCI World and the MSCI Asia X Japan indices. The INR depreciated by 1% against the USD, while the benchmark 10-year Indian government bond yields rose by 8 basis points to 7.19%. In our view, domestic risk assets are likely to consolidate in the near term, post a strong rally since March of 2023 lows, given elevated valuations both absolute and relative to peers. Going ahead, we see two competing narratives: India's robust domestic macro environment that remains ahead of its major peers versus a delayed but high likelihood of a sharp growth slowdown in developed economies, likely to influence Indian assets. Against this backdrop, we maintain a diversified asset class outlook and believe a calm approach, where C in the acronym is for capitalize on market opportunities within debt and equity asset classes. A is for allocate broadly, where we prefer to stay diversified across all asset classes. L is for lean to Asia, where we see structural opportunities in India in the infrastructure and manufacturing sectors. And M is for managed volatility, where we adopt a barbell-like sector strategies where we remain overweight on domestic cyclicals like financials and industrials and add a defensive tilt through an overweight in healthcare. We also like hybrid and multi-asset strategies in the current market environment and also look for opportunities in alternative strategies that lower portfolio volatility. Coming to macro views, on growth, we expect India's economic growth to track above its long-term trend and stay ahead of its major peers in the second half of 2023. We see India's growth to be resilient to weakening global growth given supportive government policies, sustained revival in services, and a pickup in private capex. Further, a likely peak in RBI's policy rate could boost consumption demand. As per Bloomberg estimates, India's GDP is expected to grow by 6.1% year-on-year in fiscal year 2024. In our assessment, fiscal policy is likely to be the key driver for growth in 2023, with financial conditions being tighter than normal. The past measures undertaken by the government, which includes greater public capex spend, long-standing reforms related to taxation and labour, and providing incentives to boost manufacturing and infrastructure, is likely to boost India's medium-term growth outlook. In our view, the RBI's decision to keep policy rates unchanged in its last policy meeting and subsequent low inflation prints likely signal an end to the rate tightening cycle. On inflation, we believe CPI inflation is likely to trend lower in 2023, tracking within the RBI's medium-term target of 2% to 6% given high base effect, easing commodity prices, and lagged impact of monetary policy. Now, coming to key asset class views, we remain neutral on Indian equities as we expect robust domestic growth and strong corporate earnings cycle to be counterbalanced by stretched valuation premiums, both absolute and relative to peers. The Nifty index registered an earnings growth of 11% for fiscal year 2023, while the expectations for fiscal year 24 and 25 are expected at 19% and 17% respectively. Within equities, we are overweight mid-cap and small-cap equities given broadening growth momentum, improving earnings outlook, wider industry representation, and a likely peak in bond yields. We prefer value-style equities. On sectors, we prefer a barbell strategy where we like domestic cyclicals and maintain an overweight on financials and industrials, and we balance this by a defensive tilt in the portfolio through an overweight on healthcare. On bonds, we maintain a neutral stance as we expect attractive absolute and real yields to be counterbalanced by below average yield premiums, stretched medium-term fiscal position, and weak government bond and demand supply balance. In our view, the RBI's decision to keep policy rates unchanged in the latest monetary policy indicates the likelihood of bond yields being closer to the peak we expect the 10-year Indian government bond yield to likely trade in the range of 6.75% to 7%. Yields edged higher in July, but we see this as an opportunity to lock in attractive yields with a likely peak in bond yields given RBI's recent pause in policy rates. We are overweight medium and long maturity bonds, and we have a preference for corporate bonds that offer a yield premium over government bonds. As in our assessment, the high-quality corporate bonds offer a better risk-reward amid attractive spreads and improving corporate fundamentals. In addition, Indian bonds' real yields, adjusted for inflation, are higher compared to other emerging market peers. However, we see three factors possibly unfavorable for bonds, and that includes fiscal deficit, which is likely to remain high over the medium term, worsening government bond supply balance given high supply of government bonds amid a lack of support from the RBI, and above average inflation, which would keep bond yields elevated as RBI maintains a prolonged pause on policy rates. Cash continues to remain a neutral holding, and finally gold remains a neutral holding and a key portfolio hedge against elevated inflation and equity market volatility. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.se.com/in.